Hi, everyone. Welcome to the Multifamily Dispatch. I'm Dan Gable, CEO of J+G Companies, and I'm joined by Dr. Matt Bastnagel, our Director of Marketing and Research. Matt, how are you recovering from the exciting FOMC meeting yesterday? I know you had your popcorn and you were intently listening and hanging on every word that Mr. Powell was saying. I'll tell you one thing, the market did not like what it heard yesterday. Treasury rates ripped across the curve about 11 basis points. They're down quite a bit today, which is good news, but it's not helpful when they rip like that.
Yeah. I personally was aghast at when the FOMC commentary changed from somewhat inflationary to inflationary. They talked on Bloomberg for like 15 minutes about that one word. It was a perfect FOMC meeting. Lots of drama, even though we knew exactly what was going to happen. Well, we're going to tell you what is going to happen in the multifamily market and the housing market today. And for multifamily investors, we've got some updates on how delinquencies are going. But first, Dan, I'm dying to get your breakdown of another blockbuster FOMC meeting.
Well, so rather than focus on a specific article this week, I will just give you my 2 cents after watching the press conference. So first, if you like watching the press conference from the FOMC, I highly recommend viewing it on YouTube. It strips away all of the scrolling ribbons and fancy graphics that you find on the major networks. Allows you to just focus on what Mr. Powell is saying.
Yeah, just how it's intended. Yeah, that's right. Nice. It's like listening to a really nice album.
Yeah, exactly. Exactly. So for me, it was just easier to focus on what was being said and not on all the eye-catching graphics and distractions. So 40 minutes into this, and I'm thinking, why did the market puke so bad? He just keeps saying that the easing bias remains overall unchanged.
Yeah.
He does a great job walking the political line and professional tightrope supporting Kevin Warsh coming in and some of his new ideas about communication strategy. He is downplaying kind of the adjustment that the Fed is going to have to make with Warsh coming in. He continues to say that he believes they will look through not only oil price shocks, but also the tariff shocks. All I hear, and maybe it's just my wishful thinking, is that we might still cut rates this year. But then he said something along the lines of, is a hike as likely as a cut? Some people on the committee are trending in that direction. And I think that's what threw everything off. He clarified pretty quickly, like, no, what I mean is like people are just moving back more to neutral. Like the attitude is more neutral, not to a hiking situation.
Okay.
But he did say he still feels like current policy is perhaps slightly restrictive, meaning, there's some room for cushion. I think if you listen to his remarks, there's a sense of neutrality and a wait-and-see approach, but no change to the bias to lower rates in the future if inflation behaves as expected. One thing Powell mentioned was the role that the press plays in educating the public about the role of the Fed and their careful reporting, right? And
nice.
Yeah, it was nice. I think it was a nice thing for him to say to the press, and that certainly got a lot of support from the room.
Yeah. For us.
But what did they? Yes. But what did they do in return? Well, they focused on all the negative news and the four dissidents, and this higher for longer narrative, which I think made the market spike quite a bit yesterday. As exciting as all of this is, Matt, what does it mean for real estate investors? And it's not really much different than what we've been saying here. This is the new normal. Get used to it. Plan for it to stick around for a while. It means stable cap rates, which is good, but higher interest rates for longer, which is not good for financially engineered value increases.
Yeah.
So will this new normal bring more capitulation from the sell side and deal activity? I hope so.
Yeah. I think that there is this idea of this like kind of false hope that's been promulgated or, really entertained for the past 3 years. And I think that the messages from the Fed are pretty clear, like we're not going to really give in that easily. I had another question though, in some of the discussion, both before and after the FOMC meeting, there was talk of a symmetrical policy in the Fed. I was a little confused about that because it seems like, it's one person's symmetry is another person's out of balance. So if you could explain that a little bit, that would really help me.
Yeah, no, and I had to look this up too, Matt. So I went down a rabbit hole here. And since this is a multifamily podcast, I'll spare our listeners and viewers the details, but I'll offer just a kind of a quick, brief explanation. So if you want more information, ask your favorite AI chatbot if the Fed prefers asymmetric over symmetric inflation targeting.
Yeah.
And you'll get all the data you could ever want. But basically, prior to COVID, the Fed viewed inflation in symmetric terms. That is, it's equally bad to be under the target as it is to be over the target.
Okay.
Or it could be interpreted as we're just as likely to miss our target to the high side or to the low side.
Mm-hmm.
So that's the symmetry of hitting that 2% target. There's the other side of the argument where the symmetrical mandate, right, where you've equally weighting the importance of inflation, keeping inflation under control, and keeping full employment.
Okay.
Why is this coming up now? Well, back in August of 2020, the Fed replaced their language from symmetric to asymmetric, and they changed their flexible inflation target with a flexible average inflation target, which replaced the symmetric approach to an asymmetric approach, basically saying, hey, over the long term, it's been years and years and years of very low inflation, and we haven't been able to get to that 2% target. So maybe we can run hot for a little while over the 2% target, and it'll just average out and be okay. Well, that pesky word average being added into the vocabulary, well, average over what period, right? Average over 10 years, 15 years, 2 months? What's the period that we're trying to achieve here? So this thought was, okay, we can run a little bit hotter, and people kind of blame this change to the Fed's hesitancy to move on inflation more quickly in 2021. So all that being said, essentially the Fed is returning to this symmetric ideal where it's just as bad to undershoot it as it is to overshoot it, and we need to keep some balance between unemployment and inflation. So if that means that we've got to sacrifice employment to finally knock down inflation, that's what we're going to do.
I just see this symmetry is in the eye of the beholder. I feel like it was also maybe borne out after the Great Recession, where maybe there was not enough, call it stimulus or what have you, but they didn't really do enough to encourage things on that end, maybe didn't encourage job growth and economic growth, and were a little too tight-fisted and during the Great Recession. And then maybe they're a little looser and after the pandemic. I just think that there's different definitions. One person can see a symmetry in another, and another see something different. So I take issue a little bit with that wording, but that's the official wording of the Fed. So a lot of money hangs on that word.
It does. And, this 2% inflation target is, like this Goldilocks zone, right? So that's the idea, is this Goldilocks zone. And in order to, achieve that, how do you ratchet up rates or ratchet them down, which is what causes the unemployment issue. Yeah. Right. So, it's not too hot, not too cold. If we can get in this 2% range, that's great. So speaking of not too hot, not too cold, what's the Goldilocks zone for multifamily investors?
Yes. So it was a little bit of a tale of two rent reports this week from Apartment List. A little bit of a best of times, worst of times, which is nice.
Dickens. Nice.
Yeah. Great. So yes, on the one hand, we have the same rent growth dynamic that we've seen for the past 3.5 years. Monthly rent growth is 0.5%. There we can see it right here. Year over year, rent growth is negative 1.7, which has really helped make affordability better for renters, but it has made things worse for apartment owners and operators. Just a quick note, though, on that national rent growth number, so much of that negative number is due to places in the Sun Belt and large Sun Belt cities that have dragged down that average. You can see how San Antonio has negative 5.1, Austin, Texas, negative 5.7, places like Phoenix, negative 4.4, Nashville, negative 3. These are all dragging down that average. And on the other hand, though, the Midwest doesn't have that negative rent growth. It has positive rent growth, but its rent growth is just not strong enough to lift up the average there. So the South census region just has a clear numerical advantage as well. So yes, for apartment investors, I think it certainly seems like the Midwest looks like a great place to look. But I have noticed a new narrative pop up, and I just want to kind of trace it out here. So first, you had the Sunbelt success narrative. That was maybe pre-pandemic and still persists today. The people are moving to the South. The businesses and jobs are growing in the South. They're loving it in the South. And they're also investing in apartments. And that's an easy win because, you come to Orlando, come to Greenville, South Carolina, booming growth in Charlotte, follow Joe Rogan to Austin, so on. Easy win, right? Then we get to the Midwest counter narrative because I know that our listeners are probably familiar with this. They've built a lot more apartments in the Sun Belt. Rents are falling, which is bad for apartment investors, good for renters, but bad if you want like cash flow. In the Midwest, there wasn't this crazy high apartment building and rents have been more stable, which is less bad, so better for cash flow minded investors. So that's that counter narrative. But then now I'm seeing, and again, it was always kind of present, but now there's this emerging undercurrent narrative that's popped up now, which is don't count out the Sun Belt. That's essentially the gist of it. But this narrative emphasizes the population growth and economic growth, ignoring kind of the negative rent growth under the assumption that the demand drivers will outweigh the supply growth. I think that the real narrative is you have to weigh supply and the demand drivers. So it's not just, yes, you can nod to it and say, oh yeah, that's population growth. But I think that it is still like 2 years too soon to expect strong positive rent growth in the South. I'm sure certain markets in the South might have stronger rent growth. Virginia Beach right now, which is like on the northern edge of the South, that's doing great. But if you're an investor right now and you had to pick the best of times and the worst of times, it's a little better in the Midwest and you're feeling a little worse in the South. So yes, nationally, apartment lists rent growth is quite low, but there's some growing signs of balance in the market. Apartment List has recorded the first decline in apartment vacancy in quite a long time. In
like 5 years.
Yeah, over 5 years, which is really notable. It is one data point, but I think it's an important data point only because this thing hasn't happened for 5 years. And there isn't typically a whole lot of volatility in the trend line that you see here. I'll pull it up right here. It's just a very smooth increase until right last month where it just ticked down ever so slightly, but perhaps meaningfully. Again, significant milestone. Apartment List typically posts lower than average rent growth rates. And that's something that is kind of baked into my understanding of where Apartment List ranks among the data sources like Yardi Matrix, CoStar. However, they did post a higher one when apartment rents were peaking. And they're an important data point. Maybe they're noticing this trend, whereas they've seen things pretty negative, and to see it in the positive is really nice here to see. So the best of times for apartment operators, maybe a little bit further in the future. Supply growth in the apartment market will continue to decline. We know that. And that decline's fairly certain because you look at permits here, the permits really fell down. And then after permits come starts, and they really fell down. And then that is going to mean that completions are going to fall. They've since kind of come up just a little bit, not up to their peak, but we're still in this point where we're waiting for that fall off in permits and starts to show up in completions. And RealPage has noted this as well. They have a recent article which is titled "Quarterly Apartment Supply Hits the Smallest Volume in 4 Years." Back in the second quarter of 2023, this is a quote. Quarterly completion volumes surpassed 100,000 for the first time since RealPage began tracking in the 90s. That milestone kicked off a 5-quarter streak of rising deliveries, culminating in a peak in third quarter 2024, which is the height of the supply surge. So basically this chart right here, if you're a YouTube viewer, if you're a listener, I will be very good at describing this. It describes how for 2 years, beginning in Q2 2023 and ending in Q2 2025, quarterly completions were above that 100K threshold. That's a pretty accurate measure. Those like 5 quarters. That's a pretty accurate measure of the recent wave of newly built apartments. And that, again, was a period of apartment building that was the highest since the 1970s, a real generational high in apartment construction that we probably won't see anytime soon. So we've got that supply growth that has really taken off in Q2 2023. And then about a month later, in July of that year, that's when rent growth turned negative in the Apartment List numbers. So the drop in rent growth is a little bit of a snapback from the high rent growth that we had, but it's also, I think, apartment market reacting to that new supply a lot quicker than I thought. I thought maybe it'd be months ahead and then finally we react. But I've talked to property managers and professionals, and if an apartment is being built around the corner, they're preparing for that way before that's even completed. They're kind of, whether it's concessions or they're lowering the rents, like it's much more responsive than one would think, given the length of time it takes to actually complete it. Well, the length the market takes to react is a lot quicker.
That's right.
Yeah.
And, I mean, real estate is local, right? It's all about locality, location. When you drop 200 units or 300 or 400 units of new supply on one location, it takes some time for that to absorb. And so, operators that own nearby, they can see that coming from a mile away, and they have to start preparing for that right away. So it makes total sense that rents would decline.
Yeah. And this is just intuitively, but it seems also that, yes, they can adjust the rents and that'll happen quickly, but the eventual rise and like adjustment to the new supply, that's going to take a lot slower, because you can't just adjust the rents there and bring people in. But maybe, and I think that's probably why we've been in this low point for so long, is because it's taken a lot of time for the market, to absorb the new supply. Returning to apartment supply trends now, we are very clearly in this post-supply wave period. Apartment rents went down quickly as apartment supply went up, but rents, like I mentioned, they may not bounce back as quickly because that supply wave lasted for a long time. And even though we're past that apartment supply wave, apartment supply growth has not dropped a huge amount, and it's a little below average. It probably will continue to get lower, but there's just going to be some time for the market to adjust, for things to get absorbed.
Yeah, absolutely.
Yeah. So supply and demand, there will be lower supply growth, and the lower vacancy numbers from apartment list suggest that demand is steady. We'll see evidence elsewhere of consistent housing demand and the important role of rental housing when we discuss homeownership trends. But first, what are the trends, Dan, in the lending market for people that are buying apartment buildings?
Yeah, I'm glad you asked that, Matt, and I'm glad you included this article from the Mortgage Bankers Association regarding delinquency rates for commercial properties increasing in the first quarter of 2026. So distress has been the watchword for the last several years, and we've predicted that this year will be the year, 2026 will be the year that distress from over-leveraged properties really gets sorted out. So if you're a distressed buyer, this is your year to buy. We think that there will be less distress probably in 2027, just given the calendar of when these loans mature. After all, we're 4 years removed from the last wave of highly leveraged, low interest rate debt fund loan originations. So I find a few things interesting in this article. First, the article reports the percentage of delinquent loans by loan type. As expected, CMBS loans kind of lead the pack with 5.21%, up from 4.97% at the end of 2025. It's not surprising because CMBS acts more like a catch-all, where their bond pools contain all food groups: retail, office, industrial, hotels, and multifamily. And the multifamily loans that are included in these pools are usually a little less desirable because otherwise they would be in agency pools, Fannie and Freddie. So it's not a surprise to me that CMBS delinquency is kind of by far and away the highest of all of these options. Right behind it is life insurance companies. I should say a little further behind it is life insurance companies, which actually saw a decrease in delinquency. So, down from 1.5% at the end of 2025 to 1.4%.
How was the life insurance debt pool characterized? So if you said the CMBS takes some of the loans that the agency couldn't, what is the life insurance? Or how are they?
Yeah.
Safe?
Well, they'll take the same stuff that a CMBS will take, a CMBS lender will take, albeit at lower leverage and higher quality. So that's why there's a pretty significant gap in delinquency. So,
Yeah.
you know,
So life insurance is a little more selective.
they're way more selective. They may have some retail, some office, some industrial, some multifamily in their portfolio, but it's going to be at much lower leverage, like 55 to 60% of value.
Loan to value. Okay.
Yep. And, probably what's causing the delinquency, I have no data to back this up.
Yeah.
But probably what's causing that delinquency would be like the office assets that are in their pool where people have just said, I'm not leasing office space anymore, dropping the revenue to those assets.
I'm going to steer a little off script.
Yeah.
What do syndicators go call up life insurance companies for debt commonly, or is like how often does that happen? That are there among the debt options? We'll go agency, we'll go life insurance. Okay.
Yeah, absolutely.
Interesting.
And it just depends on what your strategy is. If you're a long-term holder and you want to amortize down debt, life insurance is a great option.
Okay.
If you're shorter term, or I should say, if you're shorter term, life insurance is really not a great option. Or if you need, a little bit more leverage to make your returns work. So like the best life insurance borrower is somebody who's on the coasts buying a high quality asset where, they're happy putting in, 45 to 65% of the equity to acquire the property.
Interesting. Really interesting.
Yeah.
Yeah. I just didn't know how that worked.
Yeah.
Because insurance can be a problem for commercial real estate.
Yes, indeed. And yes, we could do an entire podcast
and I
on
can't
that.
wait to do that.
But kind of back to this article, we head to Fannie, Freddie, and HUD. Collectively, this should be a category of its own since they only finance multifamily.
Yeah.
So Fannie and Freddie showed delinquency at nearly 1%, up from 0.63% at the end of 2025, and nearly matching the delinquency among HUD loans, which also increased from 0.65% to 0.96%.
Okay.
It'd be interesting to see, like, geographically where this delinquency is located. Again, I have no data for this, but I would suppose that it's primarily in Sunbelt markets where the original loan placed in 2022 or 2023 is based on a really high value. Maybe the loan's running out of its interest-only period and it's beginning to amortize, and the asset is facing rising insurance, rising taxes, amortizing debt service, and now falling rents. So, it's important to note that this data does not include floating rate debt, the high leverage, debt fund and bank loans, which is really where most of the distress lives right now. So the important takeaway from my perspective is that, delinquency is still rising, even in stabilized assets, which means lenders are going to keep tightening their requirements and their credit standards and being more selective going forward, which will keep a lid on values in the near term.
Yeah. I'm particularly struck by how multifamily delinquencies seem to have the most consistent upward trend. And, maybe it's not a wave of distress, more like a swell. But I'll also say, like, it's not as if the bottom is falling out of the multifamily market.
Yeah.
And I think that the reason why the word distress is greeted with excitement, and those are always the emails that get the clicks, is because there is so much housing demand in the country, and investors can kind of count on that. There's not enough homes, and I think that this next group of articles really illustrates that really well. So these are a selection of ones really based on how home ownership has been a barrier for a lot of people. There's this one from Realtor.com saying that home ownerships are falling for all ages, not just millennials. I'm just going to cut to the end quote here from the Realtor.com article. It says that the result is that home ownership is increasingly functioning less like broadly accessible wealth building tool and more like a financial milestone reserved for those who are already well positioned to begin with. these affordability pressures, they're kind of hitting younger buyers. They're making the average first-time home buyer get older and older. And we also, in the Realtor.com article, we get a reference to that lock-in effect, where rates were really low and they're not selling. Although I've seen data that suggests otherwise, that lock-in effect is really fading after so many years of elevated interest rates. So that's a little bit of like a reassurance, but homeownership is still lower than it should be. And I think that the charts in the similar apartment list article on home ownership are a little bit more descriptive and explain things a little bit better than in the Realtor.com article. And we can see here how home ownership, actually, it's not a recent thing there where home ownership has declined. The real decline happened from 2005 to 2015. And then also homeownership increased then from 2015 to 2022 or 2023. And why did homeownership fall? Well, I'm sure I don't think that it was because of high home prices. I believe strongly that it was high interest rates, and I don't think that that's a hot take. There's also, but I do think that high home prices played a role in it, and it is helping to kind of keep people out of the home buying market. And this article from the Joint Center of Housing Studies from Harvard University talks about the disappearance of the moderately priced single family home. And the argument posited in this little commentary here, it suggests that efforts to increase housing affordability are more often centered on building a bunch of apartment units, and that helps, but it's not necessarily a perfect solution for home buyers. Other policy decisions seem to disincentivize building these lower cost, so-called, I guess, starter homes. The quote is starting in the late 1960s, suburban towns in metropolitan Boston imposed layer upon layer of regulations, including large minimum lot sizes, stringent land use policies, and complicated and lengthy permitting procedures. As a result, most suburban home builders in Greater Boston only produced houses for the high end of the market. At the same time, the starter homes built in previous generations in neighborhoods like mine are disappearing. I think that's... I always feel like these larger cities are a little bit more like regulatorily burdened than others. But that's something that's happening everywhere. I think there is a bias in general. If you're a builder, you're going to make more money building those larger homes anyways. So in a sense, there has to be some kind of conditions that encourage the smaller homes to be built. The solution that the author has suggested here is... Well, he mentions a novel effort that would allow the building of single-family homes on smaller lot sizes, and states and local governments could go further by acquiring land for development of various types of housing, providing financial assistance, tax exemption for these smaller homes. Finally, he says that protecting the existing stock of smaller homes is important too. He said, the quote here is, just as they currently use floor to area ratios, local governments could set a formula based on the current volume of a house to limit how much within a certain number of years an owner could enlarge a structure, or if it were demolished, its replacement. In that way, small houses like the disappearing bungalows in my neighborhood might remain available for young couples and families who yearn to own their own home. It seems a little bit of like regulatory solution, a little too much red tape there. I don't know. What was your opinion on that?
Yeah, no, I don't love that idea.
Restricting remodeling.
Yeah, that seems kind of silly, honestly, and a good way to discourage people from buying those types of homes, right?
Instead of discouraging people, maybe discouraging the larger homes, maybe it's something to encourage the smaller homes. I think that this... what he mentioned on lot sizes was really interesting too. There is a happy medium though, and I do wonder though if the way that the finances are and the way that the profit motive for these construction companies are, that you have to do something special with the government in order to make building these small homes affordable. But
yeah. I mean, it comes down to NIMBYism, right? And you have towns that want to protect their school system and. It's a much larger problem than just snapping your fingers and throwing some regulatory stuff into it.
A lot of this, the YIMBY or NIMBY situation boils down to where is the government going to exert its control? Is it at the neighborhood level or the city level or the state level? And essentially, I think so much of this housing has to do with the big boys. I don't want to say beating up of the little guys, but like, I'm sorry, the needs of the many, and this is very communist of me, but like the needs of the city outweigh the needs of the neighborhood. And this is, and it is a situation where you could help 400 households get housing, and cheaper housing could really flourish if you were to build an apartment building. But then the city would want that, but the neighborhood wouldn't want it. No neighborhood wants it. So you have to someone's got to take a hard line. And I think it is a situation where, all right, where's the real power going to be held, and who's going to be allowed to hold that power?
Well, I'll just put in my 2 cents here real quick. I think that market forces probably are the better way to go. I mean, if you look at, this article has a bias towards Boston, right? Yeah. And Indianapolis in the Midwest is nothing like Boston in terms of the way the city's laid out, in terms of land scarcity. I mean, we have tons of land. Yeah. So like, if people are willing to move, there are lots of low cost options in the Midwest, right? So it's not Boston, it's not Chicago, it's not New York or New Jersey or DC. Yeah. But look, there are lots of starter homes available in Midwest towns.
Yeah, no, that's true. I think that the crunch is felt a lot different in a lot of different places, and that it is something that it was part of the Midwestern narrative, where of like affordability. Maybe it's good to invest because this one has legs for growth. There's a gap between the affordability still, even as they built so much in the South. It's more affordable to get houses and to live in the Midwest. So I think that is really interesting. And like, I do think in a certain amount of this, housing unaffordability does kind of support continued rental housing demand. I think that the relationship between the two is a little more complicated, though. I know that there has been, again, another narrative of would-be home buyers just kind of going right in to be renters. Now, I think that might happen a little bit, but the apartment market did not suffer as much as single-family home prices did during the Great Recession, which points, I think, to some separation actually between home ownership and rental housing demand. I know on the whole, as housing moves, the apartment market moves, and the home ownership, the single family home market moves. Generally, they'll go together, but there are some important points where they are diverging. I think right now is one of them. I wonder what happens here is that instead of a simple like more renters effect, is that you'll see a continued softening in home buying prices, and rental housing will be less impacted by these softening home prices. Basically, kind of, I have these doubts that high home prices are feeding directly into apartment or rental housing demand pipeline. I think that the relative affordability of apartment rents has insulated the apartment market a little bit from, and maybe a lot, from a potential downturn or correction in single family home prices. I think maybe we will see like headlines in the Washington Post and maybe Wall Street Journal about a shaky housing market. And, maybe you'll be at a cocktail party and you'll have to explain, well, not in the apartment market. Oh, I heard the housing market's going bad. Well, no. I think that we may be in this situation where home prices are going down and rents are going up, particularly in the Midwest. I think the South will be still a little shaky, but like you said, in the Midwest where things are already affordable, things are very, very stable here.
I want to just real quick say, I don't think we will see as big a housing correction in the Midwest as you're going to see elsewhere.
No,
right?
I agree.
In the Southeast,
sure.
Right? Because we just didn't build as much.
Yeah,
right?
yeah.
It's the same story over and over.
And exactly. There's just more stability. There was just lower total building.
That's right.
So I think there may be some shakiness in the South, but we'll be relatively stable here. I know that we haven't mentioned the high oil prices and maybe worrying recession risks still in play, but I think that the apartment market is on particularly firm footing, and we'll be here every week to report that on the Multifamily Dispatch. Or if you are interested in the Multifamily Newsletter, you can go to themultifamilydispatch.com and sign up for the Multifamily Dispatch newsletter.
That's right. Thank you, Matt. And unlike Mr. Powell, we will see you next time. Thanks for listening and have a great day.